the moment. So I think the fact that we've hung in around this level shows how strong, or shows the strength in the gold market at this stage.
Well, I did promise the audience we close on gold. You have a gold ETF, BAR, one of the lowest cost ETFs for gold out there. Your views on gold going forward? We talked about the FOMC raising rates. We talked about inflation. We've got a lot of forces playing in for gold's favor and also against gold, right? You got higher rates, higher dollar, but also inflation's still strong. So lots of interesting things happening for gold.
Yeah, I think let's start with the negative. So let's start by saying this is probably one of the worst environments for gold possible right now. In other words, you have a surging US dollar, highest dollar that we've seen against other major currencies for decades, coupled with a FOMC who are raising rates faster than most, or if not any, say, major developed economy in the world, and are committed to fighting inflation. So you have this cocktail of rising dollar, rising interest rates, which is incredibly destructive for gold. So that's the negative. The positive is I'm actually shocked in a way that gold is not much lower than it is at the moment. So I think the fact that we've hung in around this level shows how strong, or shows the strength in the gold market at this stage. Cryptocurrencies clearly have kind of disappeared from the competitive landscape in terms of being a viable competitor to gold. Stock market, in terms of the equity markets, down, the bond markets down. Commodities and gold, and I'm not putting them in the same general bucket as commodities, have really been kind of one of the best places this year. And I think, again, going back to the FOMC where we started, David, I think if there's any indication that, by raising 75 basis points tomorrow, I think we'll be back to neutral-ish, where we were kind of before the COVID crisis, so around 2.5%, roughly, something like that, 2 to 2.5%. And so if that means from the FOMC perspective that we've reached a sort of neutrality, on interest rates, and perhaps it means that the pace of further raises will be lower, slower, or maybe not even at all. And I think that is the signal for gold to go higher, because it's difficult for gold to go higher, as we've seen in the market, while we have this dollar strength, this really, really high dollar strength, and also this environment where the market doesn't know where the terminal Fed fund rate is going to be. But I think as soon as we have some kind of sight of where that is, it makes that much easier for them to be priced in and let gold sort of go or resume an upside trend.
All right. Let's turn to the metals and commodities now. Interestingly, the stock markets and crypto markets are not the only markets that have been falling. We'll talk about gold towards the end of the interview, but I'm just talking about the base commodities and agriculture, soft commodities, hard commodities. Those have been in free fall basically for the last 2 months. I'm looking at steel down, copper down, lumber. It's gone up a lot last year, came all the way back down. Agriculture commodities, we talked about some of the raw commodities behind food. Barley, for example, has gone up. Wheat has gone up. But the agricultural index, as defined by the Food and Agriculture Organization by the United Nations, that index has been trending down for 3 consecutive months. It seems like everything's going down. Let's talk about why first and what this means.
Yeah, so I think we've got to put it in context first of all, David, that everything is still up, on the year, and quite significantly up. That what we've had is a pullback in line with the broader market on fears of recession. So over the last few months, we've seen not just a fear of recession, driving expectations lower, but we've seen the big lockdowns that are happening in China, contributing to decreased demand coming out of China. Also, we've seen some of the premium in the Russia-Ukraine conflict coming out of the market, and a lot of those commodities are now trading at sort of levels that we saw before the war actually started. So again, showing signs that some of the premiums come out of the market due to that particular situation. So I think those 3 things combined are really contributing to where we see commodity prices just now, and the reason behind the drop in the last couple of months. But supply issues are still in place. Nothing has changed. If anything, it's getting worse with the games that Russia's playing in Europe over the Nord Stream 1 pipeline with gas delivery, obviously, to Europe. and European countries having to respond by cutting their consumption, a voluntary cut at this stage, but cutting consumption by 15% going into the end of the year or to the winter season. So these things are all very, very real. And I think the only thing at this point, David, is really what happens to demand. And it's really the only thing in my mind that can really slow commodities down is demand destruction, which is what we're really seeing in terms of anticipation of a recession and or China's reaction to COVID.
So you're saying that these commodities are anticipating a recession. Well, could they also be a leading indicator for inflation? Perhaps the market is signaling to us, Will, that inflation has peaked. Do you think that's the case?
It certainly could be. I mean, again, inflation is much more complex than just the commodity market. So certainly some of the commodities that are important to people, such as oil and gas, for example, reduced oil and gas prices, signal that hopefully people get some relief at the pump, for example, in terms of gas prices. But inflation, as the government measured it as far as CPI, is much more complex than just commodity prices. And the commodity prices may be indicating a softer outlook on the commodity side. But again, I think the market is well supported. Indeed, you've seen a lot of the major banks and commentators switching to bullish again, and particularly on energy over the last few days, suggesting it was time to look at that again, particularly as we start coming into the winter season where we're going to be consuming more. But other inflationary pressures, I still think remain stubbornly high at this stage, particularly around housing, particularly in New York City. Again, example, just hit record all-time high for rents. Something that you would think cannot be sustainable. But other parts of the market, such as used car prices and things, although they've come off a little bit, still remain high. And I think that those will stay higher for longer than people expect.